Hey everyone, welcome to the Tax217 main exam. Now let's start off with question 1, and as with most question 1s in the tax exam, they're generally almost always going to be a tax rate question. It's quite unusual that the first question isn't a tax rate question. So as you can see here, calculate Scrabby's taxable income for the year end 30 June 2017 by preparing a rec from accounting profit to taxable income. So these questions are fairly simple. The approach is almost always the same. It's basically you set up your answer with a work paper like this, and the idea is to go from accounting profit to taxable income, and then within the question they're going to give you maybe 10 to 20 different adjustments. They might tell you what most of them are, and other ones you might have to derive from the text. And the other thing just to keep in mind is to actually use the Tax Bible notes, which you can download from our CA resources page, and also up above. You get a whole lot more in the CA tax notes that you can purchase, but as part of this exam course we're including this template here. And basically you just look up the item that you're looking for. There's so many different options here, and basically you just look for it and then just make the adjustment. So let's get started. Let's bring up the exam paper now. Okay, so question 1, and also make sure to include your section reference. Always in the tax module you need to include the section reference, and it even says it in the question right here. Provide the most relevant section reference for each item. Now there's also an unusual request in here. Provide a brief explanation to support your answer for item 14. So we'll come back to that one, but let's just make sure we're covering off everything that's required of us specifically. So number 1, it's accounting profit to taxable income, so that's fine, we'll cover that off. And then it's 1 to 17, identify the tax adjustment, that's fine, we'll cover that off. And show workings. And then number 3, relevant section reference, so we know to do that, include section reference. And then we just got to remember at the end to include a brief explanation for item 14. So let's come back to this. They've given us a list of 17 items, so let's go through them now. So first of all is prepaid salary. Okay, before we do that, let's just have a look, because we're going to start off our work paper. As always, we're going to go from accounting profit, which in the question was 700,000. Over here, 700,000, to figure out what their taxable income is. So let's start off with that. We'll just put our 700,000 in up here, and then after that we can go to our first adjustment, which in the question is prepaid salary. Now even if the answer is 0, we're still going to include it in there, just so that the marker knows what our approach to this is actually going to be. So the first thing you need to think about is it actually within accounting profit or is it outside accounting profit? Because that's going to determine our approach or our answer for it. The next step is to actually consider how does the Income Tax Act 1997 treat this particular item. So for the first thing is, the below is extracts of information from Scrabby's balance sheet and profit and loss. So that means it's actually inside that $700,000. So that's the first thing to keep in mind. Everything below is included in that 700,000. So these assets, they've already included in there. So the next thing that we're going to do is we're actually going to look up prepaid salary. So let's do a quick F, but what you can do in your exam as you practice doing these is you can actually tabulate your notes. So once you print it out, put P, T, S, D, all the letters with a little tab. So in the exam you can just quickly flick to that letter. So for example, prepayments, we know it's P, we're going to flick to P straight away. Here it is. So we've got prepayments over here. So let's have a quick read as how do we actually treat prepayments. And now of course I'm going slowly during this, but once you kind of learn the standard approach for different types of items, you can hopefully do it a bit quicker because time is of the essence in the exam. Okay, anyway, so special rules for prepayments. So it depends on whether they're a small business or a large business. So basically, if a prepayment is in one of these categories, less than $1,000 or excluded expenditure, it may be deductible in full. If it's not in those two categories, you actually just have to apportion it. You can't just deduct it in full, you have to apportion it over a series of years. So the question is, how do we treat this prepaid salary? Is it a full deduction? So we need to figure out what's excluded expenditure, because it's not less than $1,000. So excluded expenditure is less than $1,000, prepayment required by order or court of law for wages and salary. So that's going to apply here. So they'd actually get a deduction for this $35,000 prepayment. So that's the first one. We're going to actually have to include this in here. So we're going to actually reduce their accounting profit because they're going to get a deduction for this for tax purposes. Now remember, these are differences between accounting profit and taxable income. That's what we're doing. And we know it's not going to be in the accounting income because they've already put a provision for it. You can see how they've actually treated it for accounting purposes. They've actually put it to the balance sheet, not the P&L, which means that we actually do need to make that extra adjustment over here. Whereas this is going back to my first point, is considering how is it actually being treated in the existing P&L. For example, if that wasn't a prepayment, if they had expensed it incorrectly for accounting purposes, then you wouldn't actually make an adjustment because that 35 deduction would already be in the accounting P&L, and for tax you'd also get it, because they've done it incorrectly for accounting purposes. So there wouldn't actually be an adjustment because accounting would be a $35,000 expense, tax would be a $35,000 expense, except we actually know in their accounting software they actually haven't expensed this, okay? Because they've gone debit, prepayment, credit, cash, which are both balance sheet journals. Okay, so let's move on to the next one, prepaid stock. Okay, again, this is something that we're going to have to look at our notes, and it's going to be in the prepayment category as well. So let's have a look how they've treated it. So currently there's no expense for it in the accounting P&L because they've gone debit, prepaid stock, which is balance sheet, and credit cash, which is balance sheet. Now going back to our notes about prepayments, does it fit into any one of these excluded categories? And we know that they're not a small business because it's actually said in the question that they're not a small business. So let's keep that in mind. And they paid $17,000. So it's not less than $1,000. It's not required by an order or by law. It's not by expenditure for wages, and it's not an amount of capital, private or domestic. That reminds me, we just missed something in the last question, which is our section reference. So let's not forget that. So because we're talking about how it fits into this category over here, this is the section reference that we can use over here. So don't forget that in your exam. It's easy to forget things under the pressure. So just always think, do I need to include a section reference? Most of the time, the answer is yes. So sorry, let's go back to question 2. Okay, so for the for the purchase of, goods. Okay, so this prepaid stock, I want to take a look at, because we already know about prepayments, that they're not going to get it because it's not salary, wages, or less than $1,000. So they're not going to get a prepaid deduction. The next thing that I want to look at is trading stock, because it is trading stock for them. So I'm going to look up trading stock. I'm just going to go to T in our notes. Here we go here, trading stock. So it actually says in here, so we know how to calculate it, but when is the deduction incurred? So a deduction is not allowable until the income year in which the stock payer has taken the trading stock into account as stock on hand. So this is the key distinction here, and obviously on hand. So what does it say in the question over here? So it says the cupcake ingredients didn't become stock on hand until 14th of July. So that's actually when they get the deduction for tax purposes, on 14th of July. However, that's in the next tax year, isn't it? So they actually wouldn't get any adjustment for tax in this question. So the answer to this one is going to be prepaid trading stock in this current year is going to be 0, okay, because it's not going to be, they're not going to be allowed to get the deduction until it becomes on hand, which isn't until next year. And the section reference for that we can use is just this one over here, section 70-15. Okay, let's move on to the next next point, which is number 3, provision for employees' bonus. For this question, the first thing to note is how they've treated it in their financial statements. and they've actually got an expense in there already of $30,000. Okay, so now let's consider, how do we treat this for tax? So it's a bonus that may be paid to employees in August 2017. Management did not allocate any bonuses to any employees as at 30 June 2017. Okay, so let's do a quick Control F for bonus. Salaries, wages, and bonuses. Okay, here we go, directors' fees and bonuses. So it's deductible when the company is definitely committed to the payment. So this is the key word here, definitely committed. Okay, so the company needs to know for sure that they're going to pay the bonuses. They can't be contingent on something. Otherwise, you don't recognize the deduction for it per section 8-1. So let's have a look at the question. It says estimate of the bonus. So first word is estimate. That's it's not very definitive or definite. It may be paid. Again, that's not very definite wording there either to employees. And also the fact that they haven't allocated any bonuses to employees at 30 June 2017 suggests that this payment isn't certain, and therefore we wouldn't actually be able to claim deduction until it is certain, per what we just read there, section 8-1 over here. It needs to be definitely committed. So according to this, under section 8-1, there wouldn't actually be a deduction allowable. So if they've got, if they've got $30,000 expense currently for accounting, but they're not allowed any deduction for tax, that means we actually need to add back. So we need to go this way, the positive way, because we need to increase their accounting profit by $30,000. Okay, so let's move on to the next one. Let's actually be specific here. Let's say employee bonus provision, just so we don't get pulled up there and lose a mark for something silly. Okay, the next one is sales received in advance. Okay, so this is, the journal for that is going to be debit cash, credit unearned income balance sheet. So there's two balance sheet entries there, so nothing in the P&L currently, and it's sales received in advance by Scrubby's UK branch, which is a PE. Okay, so this is actually going to link into our international tax subject. So there's two things to consider here. Number one, PE, permanent establishment, and how do we actually treat that for tax, and also how do we treat sales in advance. Hopefully you've watched our videos on each of the different CSG walkthrough topics, particularly international tax, as this is a very complicated subject. But what do we know about international tax PE? Well, we know that if it's income earned by a entity's permanent establishment overseas, that income actually isn't assessable. Okay, so because that there's no P&L impact currently, that also means that there's going to be no tax adjustment either. So if you didn't know that, the alternative is, what you could do is you could actually do a Control F for branch income. See down here, branch income. So if a foreign branch is listed country and has been subject to tax, then exempt if it is a branch of Australian company. It is classified as non-assessable, non-exempt income for the purposes of calculating a tax loss, section 23AH. And what that means is, so what a branch is, it's basically when an entity, like an Australian company, like let's say, Google Pty Limited in Australia, operates in another country, like Singapore, but it doesn't actually set up a new company in Singapore. It just operates out of its Australian entity. That's a branch or a permanent establishment. So in this case, non-assessable income, but they haven't put in the P&L, so basically no adjustment we needed. So this one's going to be sales received in advance, and the section reference is going to be this, section 23AH, and it's going to be nil. Okay, so moving on to question 5, accrued electricity. So they've accrued electricity for a June 2017 invoice. The invoice was paid in July 2017. Now the journal they've got in there is debit expense, credit electricity. Okay, so we know that there's a P&L impact of $3,000 for this. We've got a $3,000 expense. So let's have a look in our tax rate guide, starting from the top, accrued expenses. So generally deductible when invoiced. Okay, so if it's a large business, it's generally when it's incurred, not when the cash is paid. If it's a small business, they might have elected to do it based on the cash basis. But generally, under section 8-1, it's generally deductible when invoiced. So that means the invoice was in June 2017. That's when we need to include the expense, which they've already done in the P&L, which is correct. So no adjustment is actually needed for this one. So this is going to be electricity accrual $0. Okay, next question. Dividend. So we've got an unfranked dividend from a small holding in an unrelated company. The dividend was received in August 2017, and they've got $12,000 in there. Okay, so we need to figure out how do we actually treat this dividend. It looks like they haven't actually included this in their income currently. So the key question is the timing of the assessable income. It says it's receivable, and it was received in August 2017. So do we actually include this in our calculation? So let's have a look at dividends in our tax rate guide. So it's assessable if in full when received by an Australian taxpayer under section 44(1). When received. Okay, so it's actually going to come down to when they've actually received the cash. Okay, not when. So it's actually going to be included in August 2017. Okay, so that means what they need to do. Extract from Krabby's profit and loss account. Okay, so what that means is they've actually posted this journal in there. See up the top, extract from P&L, and it means they've posted a journal credit $12,000. So they've actually included this as income in their profit and loss. But what we know from what we just read in the tax rec is that you'd only include this in your tax return when you receive it. So that's in August next financial year. So basically, there's going to be an adjustment between tax because they've got this $12,000 income in their accounting P&L, which isn't going to be in there for tax. So what do we need to do? We need to reduce their taxable income because they've got income. We want to reduce it so we don't have to report that income. That's going to reduce our accounting profit down. And there's our section. Oh, I didn't copy it. Section reference is section 44-1. Okay, so next question is reimbursement of overcharged stock. So I might actually just copy this like that. Okay, so let's read this question. So basically, these are amounts that were reimbursed to Scrabby. Scrabby was overcharged by a supplier for the purchase of trading stock in the last 3 years. Interesting. So they've included a credit, probably an income of $120,000. So what I would do in this case is that I'd actually Google, I'd actually Control F reimbursement. So here we go here. Oh, lost it. Reimbursement. Okay, so what does it say here? So certain recruitments are accessible, are specifically accessible, e.g. rate recoverment, so that doesn't cover, as was not included here. Other recruitments, the character of the outgoings determines whether it will be accessible. If it's on income account, then a reimbursement will be accessible. So yeah, most likely this is going to be on income account because it relates to stock purchases. So that means it is going to be accessible under that section reference. So currently they've put that income in, $120,000. For tax, it also needs to be included. That means there's going to be no adjustment. So let's just include our section reference here. We can probably just use this one, section 6-5, as that aligns with what it's saying here. So we'll go section 6-5, and there's going to be no adjustment for that. Okay, moving on to number 8. lease incentive. So they've included income of a lease incentive of $36,000. So let's do a quick Google on lease incentive. There we go. I lost it. Lease incentive. Okay, so what does it say here? Amount of incentive is income if in ordinary course of income or significant profit motive. So let's have a look here. A cash lease incentive received. Okay, it looks like it is assessable under section 6-5. Okay, so that means because they've already included it over here as 36,000, that means there's going to be no adjustment here for lease incentive according to our tax rec guide. Lease incentive. Okay, cool. Nice and easy. Moving on, intra-group sales. So we've actually got $2 million of intra-group sales. Sales of a cupcake outside the ordinary course of business to a 75% owned subsidiary. The market value of the cupcakes was $3 million. For this one, I'm not going to lie, this is a really difficult one, number 9. And, you know, it's there to kind of separate the people who get a good score with a merit or 100% in the exam. There's no simple way of explaining how to answer this question. You really just need to know the details of the content. So watch the CSG videos down below for trading stock. So this actually relates to a very specific provision. And the key trigger words to know that it's talking about this is outside the ordinary course of business. So they've disposed of stock outside the ordinary course of business. When you see those words in that order, you should be thinking of, I'll bring it up, the notes under trading stock in this section here. Trading stock disposed of, I'll just zoom in a bit for you. Trading stock disposed of where is it? Outside the ordinary course of business. See how it says there, outside the ordinary course of business. The taxpayer is required to bring the market value of the stock as assessable income. So what does that mean? It means we actually need to bring the income up to the market value. See, the market value of the assessable income. So for tax purposes, what you need to record in your tax return is actually going to be $3 million, not $2 million. So that's what they've got currently. That's what it needs to be for tax. So they actually need to increase by $1 million. 1, 2, 3, 1, 2, 3. And the section reference we can use there is this one, section 70-90. Okay, moving on. Depreciation motor vehicle car. So the first thing you should be thinking of with motor vehicle car is luxury car threshold. Okay, so they've spent $80,000, which is clearly over the luxury car tax threshold. So this car is depreciated on a straight line basis over 10 years. Scrabby uses the prime cost method. So they've put in $8,000 of this. However, for tax, what we're going to need to do is actually only depreciate the portion up to the luxury car tax threshold and just calculate it that way. So we've currently got $8,000 in there. So let's figure out how to actually calculate what the difference is. So it's going to be $8,000 is what's in there currently. Car tax is actually $67,525 in the 2020 financial year, but it does actually change every single year. So just make sure that that number is correct for the year that you're doing it. That's correct for the FY20 financial year. 67,525. Now, of course, this exam paper is. Let me just make sure I did that right. 67,525. Of course, this exam paper is from a little bit older time period, so that's fine. Just calculate it based off the current year, but just know when they were doing this exam paper back in the day, it would have been off different rates. That's fine, the methodology is still the same. You just substitute what the number is with the correct one and the most up-to-date one. So just figure out what that is and just use that number instead. So basically we need to figure out what the depreciation rate is. So we just need to divide it by 10 years basically. So that divided by 10 equals 6752. So basically what we need to do is we need to add back the $8,000 like so, and we need to subtract the amount we just calculated just then. So the difference between the two is 1247. So that's basically what we're going to include in here. Once more, you know, it's going to change year on year what that amount is for this particular year. If we were doing the exam today, that's what the answer would be. So this is going to be depreciation motor vehicle. And the section reference is over here in our exam notes, section 40-230. Okay, so next question is, okay, fine. So the penalty imposed on Scrabby by a major customer for not meeting the standards under the supply contract. So they've got an expense in here of 200K in the P&L. So let's have a look at fines in our notes. So let's look up fines. Penalties and fines are specifically not deductible. However, is this a fine in the sense of the Income Tax Act 1997? That's the big question. No, and the reason is because in tax we always need to consider what it is in substance, not by title. By title, it says fines, okay? But in substance, what is it? It's not the government levying a penalty. It's not, you know, a government agency levying the penalty. What it is actually a charge by a customer for not meeting the standards required under the supply contract. Really, it's a supply contract cost. It's not a fine in the sense of it. So this is something that could very easily throw out people. It's a bit of an unfair question, really, because they've actually claimed it to be fine. But actually, the correct way of approaching this is not to treat it as a fine, but to treat it as a cost of a contract. And in that sense, under Section 8-1, we know that any cost which is linked to your assessable income. So in this case, the income is the contract income. This is a cost linked to that. Therefore, under Section 8-1, it would actually be deductible. So this is a bit of another trick question. I don't think it's a very fair question, but the actual answer to this is 0. Okay, under Section 8-1, because it is connected to your assessable income. If they've included a deduction of 200K, there will be a deduction for 200K for this as well. Okay, next question is entertainment. So whenever you see entertainment, your first thought should be FBT, okay? Because, as we'll see in a second, when we look up FBT, you're only allowed a deduction for entertainment expenses that you've paid FBT on. Otherwise, you don't get a deduction. So let's have a look here. They've included 60K of deduction over here. So the declined proportion of restaurant meal expenses in attempting to win major supplier contracts. So if I do a quick Control F of entertainment, you'll see it will say the same thing. Entertainment costs are non-deductible by default unless you've actually paid FBT on it. So that's how it's structured. It's non-deductible by default unless you've paid FBT on it. This is the exception. But per the question, it doesn't actually say that they've paid FBT on it, therefore it would be not deductible under Section 32-5. So let's go back to our question. So nothing about FBT. So they've got a deduction there of 60K. We're actually going to add that back in our question. So entertainment plus 60,000 because we're removing a expense deduction. So just keep in mind when you're putting in your numbers, especially with the stress of the exam, that you're actually putting in your putting it around the right way. So you don't do a negative, you do a positive. The easiest way to think about it is if it's an expense, right? If we are taking out an expense, what happens to your profit? So if you have lower expenses, that means your profit's going to go up. It means you're going to pay more tax on that higher number. If it was revenue and you're taking out that revenue, it means your profit's going to go down because you don't have that extra revenue in there. That's basically how you think about it. Okay, next one is bad and doubtful debt expense. Okay, so let's Google this. So only 30% has been written off as bad debts. the debts have been previously been brought to account as assessable income. 18,000 is the current deduction. So let's have a look at bad debts. Bad debt. Here we go. Deductible when written off, and it must have been brought to account, and it must have been written off as bad debt during the year of income, and the debt must have been bad. Section 25-35. Okay, so what do we know here? So number one, only 30% has been written off as bad debts, so that will be the deductible portion, and those debts have actually been included in assessable income, so we can satisfy that list of items in here per section 25-35. So what we can say is the whole $18,000 isn't deductible, but 30% of it is. So what do we need to do? We need to leave 30% in, but we need to take out 70%. So I'm going to go times 0.7 times 18,000. Yep, that's our answer there. Bad debt expense. Cool. Alright, next question is interest expense. So we've got interest on convertible notes that they've issued, and also the thing to keep in mind is provide a brief support for answering question 14. So we're going to have to actually go into a bit more detail for this one. So interest on convertible notes that they issued on 1 July. The notes pay interest at 8% per year and convert into ordinary shares into 5 years. Now the thing to consider here, the watch out here, the thing that I picked up straight away on is it's convertible. Okay, now if you've studied all the core content and watched our videos down below about understanding the core content, you'll think straight away about convertible is this debt or equity? Because just because I mentioned before, just because in title something says debt or interest expense doesn't mean that it is debt. You have to consider the substance, and if the substance is debt, then it's debt. But you could have a title, for example, could be something like notes, which sounds like debt, but it's actually converts into equity, and therefore under the Income Tax Act 1997, you actually have to treat it as equity, and you don't get an interest deduction. Okay? So this is what we need to consider for this particular question. Is it actually debt? Can we actually get the deduction for debt on that basis? The relevant chapter to actually read a bit more about this is this TOFA, Taxation of Financial Arrangements. You can watch our video on it to get a bit more understanding about whether you would actually classify something as debt or equity. Basically, you need to consider this thing called ENCO. So watch the video to kind of understand. Basically, in this situation, because it's actually converting to equity, if you go through this, debt and equity test, you'll figure out that's not actually debt for tax purposes. So you can't actually claim the interest on this. So basically, what we need to do is we need to add back this whole $24,000. For more information, watch the video on taxation of financial arrangements that we've got down below. So what I might do, and the section reference to this is 2626, and we're going to have to add back the entire amount, which was 24,000. Oops. What we have to do for this one is just add an explanation as well, because that was specifically requested in the question. We want to make sure that we're answering exactly what the markers have asked us to do. So what I might do is put our little explanation here and say convertible notes are equity per section 26-26. The reason is total interest incur less than financial benefit received, therefore not deductible. That's basically what you have to write as your explanation. If that didn't make sense, watch our TOFA video. I'm not going to spend a lot of time going through it again in this video here. It's more just to get through the question. Anyway, so let's move on to question 15, repair expense. So they've got 100K in there. They've got 40% of the repair expense relating to a second-hand oven acquired during the income year ended 30 June 2017 that was installed and ready for use in July 2017. So I think it's going to come down to something to do with this, when it's actually ready for use. If we do a quick Control F on repairs, we'll get to the repairs section in the tax rec notes. And what it actually says here is that the initial repairs, which is the case here because we've actually bought it in the financial year, and it's a new oven, well, it's a new purchase, it's a second-hand purchase. It's saying initial repairs, which is applicable here because they've just purchased it, usually reflected in a lower selling price, i.e. they've purchased it for a discount, therefore not deductible under section 25-10. So that we know that the 40% of the repair expenses is not deductible because of this provision, section 25-10. So what we need to do is we need to add back 40% of the 100k, which is going to be 40k, and have to add that back. Okay, and then move on to part 16. So employee sunglasses expense. So purchase of sunglasses as Christmas gifts to all employees. So it's going to be $2,000 expense currently in there. Gifts, sunglasses. So let's do a Control F for gifts. Gift. If you've tabulated it, you could just go straight to the letter G. Here we go here. Private expenses, gifts to approved funds. If donate trading stock. So my only question is this gift, part of, ordinary business income? Well, I had a look at FBT, and there, it's a minor benefit exemption under FBT with a taxable value of less than $300. It's infrequently provided, and or difficult to record in value, which is the case here. So no FBT, e.g. inexpensive Christmas gifts. So I think it would be deductible. I think we'll just use the generic section 8-1 because it's a gift that's part of ordinary business operations. So I think it's fine. We'll just go section 8-1. They've already put a deduction in there for $2,000. I'll agree. Put $0 as well. Okay, last one is losses. So they've got capital losses in the income year ended 30 June. They did not derive any capital gains in the 2017 income year. Okay, well, capital loss, right? It's a capital loss, but they didn't have any capital gains for the 2017 income year. So basically, according to this, and you should know by common sense, a capital loss only applies against a capital gain. You can't apply a capital loss against your normal, ordinary taxable income. And because this company doesn't have any capital losses, we can't actually use those capital losses in the tax return, which means under section 102-10, we can't actually claim this as the deduction. So we're going to have to add back the $33,000 that they mentioned. Okay. So let's have a look at where we stand for taxable income. So it should just be a sum of all of the above accounting profit plus all of our adjustments down to taxable income. Now in an exam, what I would recommend you doing if you have time is to actually spend some time going through it, just making sure you've put your signs going around the right way, you've got a section reference for everything, checking the question and coming back and making sure that we've answered everything specifically. For example, have we got an extra explanation for question 14? If you're happy with that, then move on to the next question. But otherwise, this is how you get 100% for question 1 on the Tax217 main exam. See you in the next video.